Hello, property navigators. Most Aussies buy property under their own names, not realizing that by structuring property ownership correctly, hundreds of thousands of dollars can be saved over your lifetime. This money can be reinvested to provide you and your family with a hell of a lot more options in the future. But saving on tax and expenses isn't the only outcome. There are also significant impacts on asset protection, borrowing power, and your overall future financial position. Today we're presenting the different investment property ownership structures available in Australia, giving not only insights on the pros and cons of each, but I'll also share strategies that are useful for investors specific to each structure that haven't been seen elsewhere on YouTube. But firstly, I'll get the boring legal part out of the way. Everyone's situation is unique, so this is not personal financial advice, but it is general in nature. Different ownership structures offer unique benefits, but they also come with specific challenges that need careful consideration for your individual circumstances, so please get personal advice. The four most common structures available to Australian property investors are individual ownerships, as in your own name, or ownership through a company, a trust, and self-managed superannuation fund, which are a type of trust too, but we'll get to that soon. Each has its own implications under Australian tax and legal frameworks. I'll run through each of these in order, then give a brief discussion that brings together the key points of the pros and cons so you can make up your own mind. Owning property in your personal name or jointly with a spouse or partner is the most common and straightforward form of property ownership in Australia, and where many Australian investors begin their journey. The pros include capital gains tax discounts. One of the main advantages of holding property in your own name is the 50% CGT discount available if you hold the property for more than 12 months before selling. This means that only half of your capital gain is subject to tax. Negative gearing benefits. If the expenses related to the property, for example, mortgage interest and maintenance, exceed the rental income, the loss can be used to reduce your taxable income. This is a popular outcome for many high-income Australian investors. And lastly, simplicity. Buying property in your own name involves minimal paperwork, administrative hassle, and ongoing compliance. It's the easiest structure to manage from a legal and tax standpoint. The cons. Higher tax rates. Rental income and any capital gains are taxed at your personal marginal rate, which could be as high as 45%, and a major disadvantage for high income earners. No asset protection. Properties held in your own name are exposed to personal liabilities. If you're sued, declared bankrupt, or otherwise face financial difficulty, your personal assets, including investment properties, are at risk. Limited borrowing capacity. Lenders assess your personal borrowing limits based on your income and debt. Once you reach a certain level of debt, measured by a debt-to-income ratio, your ability to borrow more is constrained. While this is the simplest structure, it may not always be the most tax efficient or asset protective strategy. It's important to note here too, the reason why you would use negative gearing is as an outcome. The capital gains should far surpass the holding costs. So if a property costs 10K per year to hold, but increased in value by 80K per year in capital growth, you are essentially swapping 10K for 80K. It shouldn't be used just to pay less tax. The trade-off of getting a 50% CGT discount by having the property in your personal name may be that you top out your borrowing capacity and can't buy more properties. The 50% CGT saving doesn't stack up when compared to the wealth that can be built when holding multiple properties from having access to lending capacity, so make sure you do your homework and the long-term calculations. You could also end up paying a ton more tax this way just to save on your CGT if and when you do ever decide to sell. So again, plan with a long-term view. Next up, we have company ownership. Property investors can also purchase property through a company. Now, a company is a separate legal entity in itself that has the same rights as a natural person. This includes to hold property, enter into contracts such as for lending, or sue or to be sued. This means company assets and liabilities are distinct from the personal assets of the shareholders and directors. Here are the pros. Lower tax rate for companies. Companies in Australia pay a flat tax rate of 30% or 25% for small businesses. This is much lower than the 45% marginal rate for high-income earners. Asset protection. As a company is a separate legal entity, personal assets are generally protected from any legal claims against the company. This makes it an appealing option for those who want to safeguard personal wealth. control over profits. Companies can retain earnings, meaning profits can remain in the company without needing to distribute them, offering flexibility in reinvesting profits into additional investments. So the beauty of acquiring under a company is you can get capital, and that capital can cost you less to acquire over time. Here are the cons. No capital gains tax discount. Unlike individuals, companies are not eligible for the 50% CGT discount, meaning the full capital gain is subject to be taxed at the company rate. Double taxation. If you want to access the company's profits personally, you will have to pay tax again when the profits are distributed to you, which are taxed at your personal marginal rate, after the company has already paid corporate tax on the gross profits. Administrative and legal costs. Running a company in Australia involves ongoing compliance with corporate governance rules, including preparing financial documents, lodging company tax returns, and keeping detailed records. The Australian Securities and Investments Commission, ASIC, impose strict obligations on company directors. So what does all this mean? For high-income earners paying a 45% marginal tax rate, meaning that 45 cents out of every dollar they earn is paid in tax, it might be worthwhile to acquire income-producing assets within a company, as this can be a tax minimization strategy compared to personal tax rates, thereby saving 15 cents on the dollar. What you're ultimately trying to do is lower your tax payable on both your income and your capital gains over the long term by spreading across structures. What's also notable is the no CGT discount can be overcome in certain circumstances. If your company has a capital loss and property is acquired under that company which grows, giving capital gains when sold, you can utilize the company to provide a capital gain if the gains don't surpass the capital losses, noting that you kept the losses in the company. So basically, the capital gain is offsetting the capital losses. Trusts, family trusts and unit trusts. Trusts are a popular structure for holding investment properties, especially for families or groups of investors. A trust involves a trustee who holds the property for the benefit of the beneficiaries. There are a ton of different types of trusts, with the two most common types being discretionary family trusts and unit trusts. Now, we have an entire video that provides a deep dive on trust structures, and the link is just down in the description. Very briefly, I'll cover the key points. What are the pros? Income distribution flexibility. In a family trust, the trustee has the discretion to distribute income from the property to the beneficiaries in a tax-efficient way. This allows the allocation of income to lower-income family members, thereby minimizing overall tax liabilities. For example, rental income could be distributed to adult children who pay lower marginal tax rates across the beneficiaries. Ownership flexibility. Unit trust beneficiaries and their respective interests are identified by their holding of units, which, much in the same way as shares, are issued to shareholders of a company. This means investors can buy and sell units, which also allows more flexibility in transferring ownership compared to other structures. And asset protection. Assets held in a trust are protected from personal liabilities. If a beneficiary is sued or declared bankrupt, creditors generally cannot access assets held in that trust. Estate planning. Family trusts are often used in estate planning to manage and distribute wealth to future generations. And capital gains tax discounts. If a family trust holds property for more than 12 months before selling, the 50% CGT discount is available, meaning that only half of the capital gain is subject to tax and borrowing power protection. To buy property within a trust, the trust gets the loan and holds the asset. Once the trust trades profitably, meaning rental income covers loan repayments and running costs, that essentially sequesters that debt from the personal portfolio. This process, often called ring-fencing the debt, ensures that it doesn't sit on someone's personal liabilities anymore, meaning personal borrowing capacity is maintained. What are the cons? No losses can be offset to beneficiaries. Any losses such as depreciation or negative gearing from the investment property are trapped within the trust and cannot be distributed to the beneficiaries to offset against their personal income. Ongoing administration complexity. Trusts require ongoing administration and compliance with Australian tax law. Trustees are responsible for lodging annual tax returns, distributing income correctly, and adhering to the trust deed. There are also specific obligations on trustees to manage trust operations under Australian trust law, and this can differ between the different types of trusts. Establishment and operational costs. Setting up a trust can involve significant legal and accounting fees, and managing the trust requires ongoing professional services. You're probably looking at a minimum 5-year timeline to build your trust investment portfolio, because if you're not investing for more than 5 years, it could just be a waste of time and money. Limited CGT discount. Remember, while individuals benefiting from a discretionary family trust may be able to claim the 50% CGT discount, unit trusts may not have the same access to this discount depending on their structure. And lastly, we have self-managed superannuation funds. A self-managed superannuation fund, or as known as an SMSF, allows individuals to manage their own retirement savings, including the purchase of investment properties. SMSFs are a type of trust that are regulated by the Australian Taxation Office and must comply with strict legal and financial rules. Now, this is a complex topic, so we have an entire full-length video specifically on this, and the link is just down in the description. Very briefly, I'll cover the key points. What are the pros? Retirement planning. Property held in an SMSF forms part of a retirement strategy. Having a solid retirement cash flow takes the heat off the government to support retirees via the pension. So the government supports this by allowing you to accumulate wealth in a tax-advantaged environment. Control and flexibility. SMSF trustees have full control over investment decisions, including property acquisition, management, and sale. This level of control appeals to those who prefer to self-manage their retirement savings. Tax efficiency. SMSFs are taxed at a concessional rate on both income and on capital gains if the property is held for more than 12 months. In the pension phase, the tax on income and capital gains is effectively zero, offering significant tax savings in retirement which maximises your personal cash flow. But what are the cons? Strict compliance rules. SMSFs are heavily regulated and trustees must comply with specific rules regarding borrowing, which are called limited recourse borrowing arrangements. There are also strict rules on property use. For example, the property cannot be used for personal purposes or rented to family members in any case. Higher costs and administrative burden. SMSFs can be costly to set up and manage, requiring professional accounting, legal, and financial advice. It's essential. Ongoing compliance includes lodging annual tax returns, undergoing audits, and ensuring that the fund meets its regulatory obligations. Borrowing restrictions. SMSFs can borrow to invest in property, but lenders often require a larger deposit and charge higher interest rates. This can make borrowing through an SMSF more challenging than through personal or corporate structures. The equity on any property owned within an SMS structure cannot be used in any case. It's not allowed, so you can't rely on equity to fund the deposit of subsequent property purchases. And policy changes. We often hear the federal government could change policy to pinch at the pockets of those who have made the right choices to provide themselves a financially secure retirement by taking more of their superannuation via increasing taxes. So always be aware of this. The most successful investors in the world look at time horizons over decades. Don't look at the 6-month time horizon and think that's more than enough. You want to be thinking in decades rather than months, and ideally rather than years as well. Remember, when acquiring assets under these entities, you can replenish your borrowing capacity because when an asset produces income and can pay for itself within that entity, you can get back your personal borrowing capacity, meaning you can invest more. This is the power of planning for more than 5, 10, or 15 years. If you like this video, don't forget to check out our video here for a deep dive in using trust structures in property ownership. Until next time, happy property navigating.